In this paper, we propose a better way to do growth investing by systematically identifying companies with sustainable earnings growth that will deliver excess returns for investors in the long run. Now, how do we do this? It may seem natural to think that when companies are aggressively investing in their businesses, it will translate into future earnings per share growth. Well, it turns out that empirically this isn't exactly true.
Let's provide a little bit of intuition to these findings. Why does a company that is growing fast, and particularly a low profitability company growing fast, produce negative growth in earnings per share? The reason is empire building. How does a company grow faster than its peers? Well, one strategy can be a very low profitability hurdle for investment. How do you launch the incremental product, open up a new territory, buy your competitor? You're willing to pay a higher price than your competitors. Now that may be great for building a big company, growing assets, growing sales, not so good for earnings per share. Unfortunately, creating simply a high profitability portfolio is not a very profitable investment strategy, because while you do get the higher growth in earnings per share, you give much of that back through a lower dividend yield and negative valuation change. The market seems to appreciate profitability, pays a premium, and you suffer some valuation decline in your high profitability portfolio.
We decompose the excess returns of the profitability and investment factor strategies into three components: dividend yields, growth in valuations, and earnings per share growth. And what we find is for the profitability factor, most of its excess returns are coming from earnings per share growth, with negative contributions coming from dividend yields and from growth in valuations. And in fact, these negative contributions wash out most of the positive contribution coming from earnings per share growth.
By focusing on conservative investment, not surprisingly, the strategy ends up being somewhat correlated with value. By focusing on high profitability, you end up negatively correlated with value. When we combine the two, the combination ends up having quite low correlation with value.
And what this strategy will do is systematically choose companies that are precisely what we would call smart growth companies. These are companies that have a high return on capital, are conservatively investing that capital, and also delivering high earnings per share growth. This means the strategy is not just buying value companies with low earnings that rebound the following year. It's buying companies with consistent, conservative investment policies that deliver outperformance and a high return on capital to investors through earnings per share growth.